The moment we've been waiting for has arrived. The Asian markets opened just hours ago and the verdict is in. The banks have failed. On Friday, they threw billions of dollars in paper contracts at the market in a desperate attempt to smash the price of silver below the critical $65 level. They needed to break the psychological momentum before the week began. They failed. As the bells rang in Tokyo and Sydney this morning, silver did not crash. Instead, it opened strong, gapping up and holding firmly above $67. This is not just a price movement. It is a declaration of war. It signifies that the Friday smash was the last bullet in the chamber of the bullion banks. They are now out of ammunition. The market has called their bluff. We are no longer speculating about a squeeze. We are witnessing the opening shots of a kinetic financial event that will likely end the dominance of the COMEX pricing mechanism forever. In this emergency breakdown, I'm going to show you why this Monday open is catastrophic for JP Morgan and the swap dealers. I'm going to explain the margin trap they're caught in and why they can't escape. I'm going to expose the industrial panic that's building as companies realize their supply chains are breaking. And I'm going to walk you through the gamma squeeze mechanics that could take us from $67 to $100 in days, not months. The Friday smash failed. The Asian gap up confirmed it. And now the short squeeze is officially underway. This is the story of the Monday that changed everything. To understand why this Monday open is so catastrophic for the banks, you have to look at their margins. These banks are holding massive short positions, bets that the price will fall. Every penny the price rises above their entry point costs them tens of millions of dollars in collateral. By opening above $67, the market has put these banks in a zone of maximum pain. They are now underwater. Usually, they would double down and sell more to force the price lower, but they can't. The liquidity isn't there. If they try to sell more, they risk being overrun by buyers. If they try to buy to cover their losses, they will drive the price to $75 instantly. They are paralyzed. They're trapped in a burning building with no exits. The stability you see on the chart right now is not peace. It is the calm before the margin call. Let me explain the mechanics of what's happening right now inside the risk departments of these banks. When you short a futures contract, you don't pay the full value up front. You post margin, collateral. Think of it like a security deposit. If the price moves against you, you have to post more margin to cover the loss. This is called a margin call. On Friday, when silver closed near $67, the banks who were short at $64 or $65 had to post additional margin, maybe a few $100 million. Painful, but manageable. But Monday opened at $67.50. Another gap, another margin call. And here's where it gets dangerous. The banks have a credit limit with the clearinghouse. Once they hit that limit, they can't post more margin. They have to close the position. But closing means buying. And buying pushes the price higher, which triggers more margin calls on their remaining positions. This is the death spiral, and we're watching it unfold in real time. The banks are calculating right now. Do they close positions and take massive losses, or do they hold and pray the price drops? But the price isn't dropping. It's holding above 67. Every hour it stays here, the pressure builds. While the banks worry about paper losses, the real economy is waking up to a physical crisis. Elon Musk and the procurement teams at Tesla are watching this open with terror. Tesla doesn't trade paper. They consume physical silver. A standard electric vehicle uses up to 50 grams of silver. The new Cybertruck uses even more. With the price holding at record highs and inventory at record lows, tech giants are realizing that the just-in-time delivery model is broken. We are receiving reports of off-market private deals being struck between tech companies and miners. They are bypassing the COMEX entirely. The shadow demand is removing metal from the market before it even reaches the vaults. When Elon Musk realizes he can't get silver for his solar panels, he won't just buy silver, he might buy the mines. This industrial panic is the fuel that will take us from $70 to $100. Because industrial users don't care about technical levels. They don't care about overbought indicators. They care about one thing: can I get the metal? And right now, the answer is becoming no. This creates a different type of buying pressure. Speculative buying is elastic. If the price gets too high, speculators walk away. But industrial buying is inelastic. It has to happen regardless of price. Samsung cannot build a phone without silver. Tesla cannot build a battery without silver. First Solar cannot build a panel without silver. These companies will pay $70, $80, $100 if they have to. Because not having silver means their factories stop. Their assembly lines halt. Their revenues collapse. A $10 increase in silver costs Tesla maybe $500 per vehicle. But a supply shortage that stops production costs them the entire $50,000 sale. The math is simple. They'll pay whatever it takes. In part 2, we're going to look at the Shanghai drain. Because while the West is fighting over paper contracts, the East is draining the physical vaults. And that arbitrage is creating a supply crisis that cannot be solved by printing more COMEX contracts. Stay with me. We're going to follow the metal. If you're just joining us, we've established that Asian markets opened with silver above $67, confirming that Friday's smash failed. The banks are trapped in margin calls. Industrial buyers are panicking. In part 1, we covered the immediate crisis. In part 2, we need to look at the force that's driving the physical shortage, the Shanghai drain. Because 7,000 miles away from Wall Street, a different market is setting a different price. And that price is pulling every available ounce of silver out of the West. The engine driving this squeeze is located far from Wall Street. The Shanghai Gold Exchange opened with a roar this morning. The premium for silver in China has expanded again. This means silver is worth significantly more in Shanghai than it is in New York or London. As I speak, the spread is approximately $4 to $5 per ounce. COMEX silver is trading at 67. Shanghai silver is trading at 71 to 72. This creates an irresistible gravitational pull. Every available bar of silver in the West is being loaded onto ships and planes to be sold in the East. This arbitrage is draining the London Bullion Market Association vaults at a rate we've never seen before. Here's how the arbitrage works. A trader buys silver in London for $67, ships it to Shanghai, sells it for $72, makes $5 profit per ounce minus shipping costs. Let's say shipping and insurance cost $1 per ounce. That's still $4 profit. Risk-free. This is called arbitrage, and it's the most powerful force in commodity markets. When arbitrage opportunities exist, capital rushes in to exploit them. Right now, billions of dollars are chasing this $4 spread. And every time someone exploits the arbitrage, they remove physical metal from Western vaults and deposit it in Eastern vaults. The West is trying to suppress the price to save the dollar. The East is using that suppressed price to drain the strategic resources of the West. It is the greatest wealth transfer in history, and it's happening in plain sight. But here's the critical point. This drain is not sustainable. The London vaults are not infinite. The COMEX registered inventory is not infinite. We're watching them drain in real time. London vaults have dropped from over 1 billion ounces a few years ago to approximately 800 million ounces today. And much of that is allocated. It's spoken for. The float, the amount available for trading, is much smaller, maybe 300 million ounces. At the current drain rate, that's 18 to 24 months of supply. But the drain is accelerating. The higher the Shanghai premium, the faster the arbitrage. And here's where it gets interesting. The arbitrage only works if you can get delivery in London. If you can't get the physical metal, you can't ship it. You can't sell it in Shanghai. You're stuck. This is why the COMEX registered inventory matters so much. That's the metal available for delivery, and it's dropping fast. 3 months ago, 120 million ounces. Last month, 95 million. This week, 73 million. If registered inventory drops below 50 million ounces, the market will start questioning whether the COMEX can function. Because there are contracts representing hundreds of millions of ounces, but only 50 million ounces available to deliver, the fractional reserve becomes obvious. Confidence collapses. And when confidence collapses in a commodity market, you get a run. Everyone tries to take delivery at once, the exchange can't deliver, and they declare force majeure. They settle in cash, the paper market breaks, and the physical market goes into backwardation where immediate delivery is worth more than future delivery. We're approaching that moment. The Shanghai drain is accelerating it. Now let's talk about the algorithms. Because for 20 years, high-frequency trading algorithms have controlled the price. These computer programs are designed to sell when the price hits certain resistance levels. But today, the algorithms are confused. They are firing sell orders. But the price isn't dropping. This is known as algorithmic failure. And when the AI realizes that selling isn't working, it's programmed to switch sides. It will flip from net short to net long. When this switch happens, likely later today or tomorrow, we will see a buying frenzy that is purely automated. The game has changed, and the same machines that kept the price of silver down for a decade, are about to be the ones that drive it to the moon. We are watching the machine turn against its masters. These algorithms, they manage billions of dollars, they execute millions of trades every single day, they absolutely dominate the futures market, and they operate on simple momentum models. If the price is rising and resistance is being broken, they buy. If the price is falling and support is being broken, they sell. Right now, these algorithms are getting conflicting signals. The price is rising, which tells them to buy. But their historical models say resistance at $65 should hold, which tells them to sell. The algorithms are fighting themselves, but physics always wins. Price is holding above $67. Resistance did not hold. Eventually, the algorithms will update their models. They'll recognize that the old resistance is gone and they'll flip to buy mode. When that flip happens, it's instant. Millions of contracts get bought in seconds. The price jumps $2, $3, even $5 in minutes. This is the algorithmic cascade. And it's one of the drivers of the gamma squeeze we're about to discuss. In part 3, we're going to explain the gamma mechanics. because this is the technical trigger that could take us from $67 to $100 in a matter of days. The options market is loaded, the strike prices are set, and the fuse is lit. Stay with me. We're going deep into the mathematics of the squeeze. We've covered the margin trap and the Shanghai drain. Now we need to talk about the gamma squeeze, because this is the technical mechanism that turns a rally into an explosion. The options market is currently loaded with call options at $70 and $75 strike prices, and as the price approaches those levels, the dynamics change dramatically. Let me explain how this works. When you buy a call option, you're buying the right to purchase silver at a specific price. Let's say you buy a $70 call. That means you have the right to buy silver at $70, even if the market price is $80. The person who sold you that option, usually a bank acting as a market maker, has exposure. If silver goes to $80 and you exercise your option, they have to deliver silver at $70. They lose $10 per ounce. To protect themselves, they hedge. They buy silver futures to offset their risk. Here's the key. The closer the price gets to the strike price, the more they have to hedge. This is called delta hedging, and the rate at which the hedging increases is called gamma. Right now, there are massive amounts of open interest at the $70 strike. Tens of thousands of contracts. Each contract represents 5,000 ounces. That's hundreds of millions of ounces of exposure. As the price moves from $67 to $68 to $69, the market makers have to buy more and more futures to hedge their risk. Their buying pushes the price higher, which requires more hedging, which pushes the price higher. This is the gamma squeeze. It's a positive feedback loop. The higher the price goes, the more they must buy. The more they buy, the higher the price goes. And here's why Monday's open above $67 is so critical. We're now within striking distance of 70, just $3 away. The market makers are starting to hedge right now. You can see it in the volume. The buying pressure is building. If we breach $70, the cascade accelerates, because then the $75 strikes come into play. More hedging, more buying, more pressure. Technically, we're setting up for a move that could take us to $80 in a single week. This is not speculation. This is mathematics. The positions exist. The exposure is real. And the mechanics are playing out exactly as expected. Friday's close was the spark. Monday's open is the fuel. $70 is the match. Once we cross that line, the explosion is mathematical and inevitable. But there's another element to this, the psychology, the sentiment shift. For years, silver investors were battered and bruised. They sold at the first sign of a rally. But look at the sentiment today. No one is selling. The silver squeeze movement has evolved from a niche internet theory into a global investment thesis. The fear of missing out is beginning to set in. Retail investors who watched Bitcoin go to the moon are looking for the next big thing. They see silver breaking out. They see the banks trapped, and they're starting to pile in. When the retail herd arrives, and they are arriving now, the liquidity of the silver market is too small to handle them. It's like trying to push the water of Niagara Falls through a garden hose. The pressure will burst the pipe. This retail FOMO is the fourth element of the squeeze. Industrial panic, Shanghai arbitrage, gamma mechanics, and now retail FOMO. All four forces are converging this week. In part 4, the final chapter, I'm going to give you the price targets and the warnings. Because while the squeeze is real, the exchange has a nuclear option, and you need to be prepared for them to use it. We've reached the conclusion. We've shown you the margin trap, the Shanghai drain, and the gamma squeeze. Now we need to talk about what happens next. What are the price targets? What's the timeline? And what's the risk that the exchange cheats? In this final part, I'm going to give you the roadmap and the warnings you need to navigate what's coming. Because the squeeze is real. But so is the danger of intervention. Let's start with the targets. If we hold $67 through the Monday session, the next resistance is nothing. There is no historical resistance above this level. We are in price discovery mode. The sky is the limit. Technical analysts project a swift move to $75. That's the first target. It will probably hit within 48 hours if the momentum continues. At 75, we'll see a brief consolidation, maybe a day or two. The market will digest the gains, weak hands will take profits, but the physical shortage is too severe for a major correction. From 75, we move to 85. This happens within a week. The gamma squeeze accelerates, the algorithms flip, the retail FOMO kicks in, and $85 becomes the new floor. Then comes $100. This is the psychological milestone, the level where mainstream media can no longer ignore it, where your taxi driver starts talking about silver, where your grandmother asks how to buy coins. We are not there yet. We're in the smart money phase. The public mania phase is still to come. And that's where the real gains are made. Timeline? If the squeeze continues uninterrupted, we could hit $100 within 30 days. Maybe sooner if the industrial panic accelerates. But here's the warning. Traders need to be prepared for the exchange to cheat. If the price gaps to $80 this week, do not be surprised if the COMEX halts trading. They will cite extreme volatility. They will change margin requirements. They will try to force liquidation. We saw it with nickel. We saw it with the Hunt brothers in 1980. They changed the rules mid-game. They instituted liquidation-only trading. They made it illegal to buy, only to sell. This could happen again. The legal mechanism exists. It's called emergency powers. The exchange can invoke them at any time. If they do, the paper price will crash. Shorts will be saved. Longs will be liquidated. But here's the difference. This time, the physical market is too strong. If they close the paper market, the real trading will move to the street. It will move to Shanghai. It will move to private peer-to-peer networks. Closing the casino won't stop the game. It will just prove that the house is broke. And it will accelerate the move away from COMEX pricing toward physical-based pricing. If you look at your screen, you see silver at $67. But try to buy it. Call a dealer. Go to a website. You will find that the real price is much higher. Premiums are exploding. Delays are mounting. This disconnect is the hallmark of a dying currency regime. The paper market claims there is plenty of silver. The physical market says there is none. This divergence cannot last. Eventually, the paper market must break. When it does, the price will not rise gradually. It will reset. We're approaching a moment where the exchange will likely declare force majeure and settle contracts in cash, because they simply do not have the metal to deliver. If you are holding a paper contract on Monday morning, you don't own silver. You own a lawsuit. This is why physical holders are protected. Your metal can't be force majeured. Your bars can't be cash settled. You have the asset. You control it. You're insulated from the paper market's collapse. But paper holders are exposed. ETFs with unallocated silver, futures contracts, pool accounts. All of these can be settled in cash if the exchange declares an emergency. Now, let me address what's not on the news today. The major financial news channels are talking about tech stocks. They're talking about interest rates. No one is talking about silver hitting all-time highs. This silence is deliberate. They do not want to alert the public. They want to keep you in the dark while the insiders position themselves. But the chart doesn't lie. The volume doesn't lie. The silence of the media is the loudest confirmation that this is the real deal. They only ignore what they fear. And right now, they fear a run on silver more than anything else, because a run on silver is a vote of no confidence in the dollar. It's a signal that the public no longer trusts paper promises, that they want physical assets, real money. This is the transition the system fears most. And Monday's gap up is the beginning of that transition. So what happens next? We're in the opening phase of a historic squeeze. The banks are trapped. Industrial buyers are panicking. The Shanghai drain is accelerating. The gamma mechanics are engaged. And retail FOMO is building. All four forces are aligned. The probability of this squeeze continuing is extremely high, but the probability of intervention is also high. The exchange will not go down without a fight. They will change rules. They will halt trading. They will try everything to save the banks. Be prepared for volatility. Welcome back, everyone. Let's dive right into the heart of what's happening in the markets, because this is a pivotal moment, a moment many of us have anticipated for a very long time. The financial landscape is shifting beneath our feet, and what we're witnessing is nothing short of a historic repricing of a critical asset. Today, we're talking about silver. More specifically, we're talking about the perfect storm that's brewing, a convergence of factors that could send shockwaves through the entire system. First, let's get one thing straight. This isn't just about lines on a chart or complex financial derivatives. This is about physical reality. The fundamental truth that you absolutely must understand is that the physical shortage of silver is real. The demand is not some manufactured hype. It's a genuine surging need from both industrial and investment sectors. The supply crisis is not a temporary hiccup. It's a deep-seated structural issue that has been years in the making. Think about it. Silver is not just a precious metal, it's a strategic metal. It's indispensable for so many of the technologies that are defining our future, from solar panels and electric vehicles to 5G networks and advanced electronics. The world doesn't just want silver, it desperately needs it. And for far too long, the paper price has been disconnected from this physical reality. Now, the market is waking up. It's beginning to discover the true price of this essential metal, and all signs are pointing to a valuation that is much, much higher than where we've been. Let's look at the recent price action. The powers that be, the big banks and institutional players, have tried everything in their playbook to keep a lid on this. We've seen rule changes, margin hikes, and coordinated takedowns. But here's the crucial point. No amount of rule changes can magically print physical silver bars. No amount of margin hikes can create inventory that simply doesn't exist. They can manipulate paper contracts, but they can't fight the laws of supply and demand forever. Reality always wins in the end. The recent attempt to smash the price on Friday failed spectacularly. It was a classic move, designed to shake out the weak hands and create panic, but it didn't work. The market absorbed the selling pressure, and the Asian Open on Monday confirmed the strength. That gap up we saw wasn't just a random fluctuation, it was a signal. It was the starting gun. The squeeze is officially underway. For those of you who have been following this story, who have been patiently accumulating and holding on, this is the moment you've been waiting for. This is validation. But for those who have been sitting on the sidelines, waiting for that perfect dip, I have to be frank, you might be waiting forever. The train has left the station. The doors are closing. This isn't a slow crawl, it's a rapid revaluation. What you're witnessing right now, on the screen in front of you, is a massive transfer of wealth happening in real time. This is the consequence of a system that has become divorced from tangible assets. For years, major financial institutions have been making enormous bets against reality. They have shorted physical commodities, believing they could control the price indefinitely through paper manipulation. And now, reality is fighting back, and it's winning. This is a critical juncture, and this is where your conviction will be tested. Do not let them gaslight you. You're going to hear a lot of noise in the coming days and weeks. The mainstream financial media will be filled with stories trying to downplay what's happening. They'll call it a bubble, a fad, a retail frenzy. They will do everything in their power to convince you to sell, to let go of your position. They want you to believe that the fundamentals don't matter. Do not let them shake you out. Remember the core principles. Remember the physical shortage, the skyrocketing demand, and the crumbling supply chain. Hold your position. Keep your eyes on the chart, watch that gap, and prepare for what could be the ride of a lifetime. The dynamics are in place for an explosive move. We're not just talking about a modest price increase. We're talking about a potential paradigm shift in how silver is valued globally. When you see the attempts to push the price down, understand what they are. They are signs of desperation from the short sellers who are trapped. Every dollar the price moves up, their losses mount exponentially. They are fighting for their survival, and they will pull out all the stops. But their ammunition is limited. They can sell paper they don't have, but they can't deliver physical metal that doesn't exist. This is their Achilles heel. This squeeze isn't just about making a profit. It's about price discovery. It's about restoring a fair and transparent market for a metal that is vital to our modern world. For too long, its price has been artificially suppressed, distorting economic signals and disincentivizing new mining and exploration. The end of this suppression will have far-reaching consequences, not just for investors, but for entire industries. So, as we move forward, stay informed, but don't get lost in the day-to-day noise. Focus on the big picture. The pieces are all in place. The failed smash on Friday, the confirmation at the Asian Open, and the subsequent gap up are all part of a sequence of events that signals the short squeeze is now in full force. This is the moment we've been preparing for, discussing, and analyzing for months, even years. It's an exciting time, but it also requires discipline and a steady hand. The volatility will likely be intense, but it's a natural part of any major market repricing. Now, I want to hear from you. Looking ahead, past the immediate volatility, where do you see this going? What value do you think silver will reach by January of 2026? Think about all the factors we've discussed: the industrial demand, the investment demand, the monetary aspects, and the supply crunch. Leave your price prediction and your reasoning in the comments below. I'm genuinely curious to read your thoughts and perspectives. Let's start a conversation. Thank you so much for tuning in today. If you found this information valuable and want to stay ahead of the curve on this developing story, make sure you subscribe to the channel and hit that notification bell so you get our new updates firsthand. It's more important than ever to stay connected. Until next time, hold strong and stay informed.